Welcome to The Explainer. I'm your analyst from Talk Tickers, and today we're digging into a really interesting one. Amwell's Q3 earnings just dropped, and honestly, the market's reaction has a lot of people scratching their heads. Let's break it down.
All right, so let's get right to the heart of it, the big puzzle here. Amwell actually delivered a solid beat. They beat on earnings, they beat on revenue. I mean, the textbook says the stock should pop, right? Well, it didn't. It tanked, dropped over 9%. Now, this is exactly the kind of thing we love to dig into. What on earth is going on behind the numbers? Okay, so first things first, you gotta understand the story that management is telling. They are trying to convince Wall Street that they're in the middle of this huge transformation. Think of it like this. They're moving away from being a low-margin, regular old telehealth company and pivoting to become this sleek, high-margin, AI-powered software platform.
In this quote from the CEO, Ido Schoenberg, it's really the whole pitch in a nutshell. He's saying, look, AI in healthcare isn't an if, it's a when, and the real question is how. He's positioning Amwell to be that how, to be the backbone, the essential plumbing that lets hospitals and health systems plug in all this cool new AI stuff safely. It's a big, bold vision for sure.
And hey, you can actually see this pivot happening in the numbers. This is a big deal. For the very first time, more than half their business, 55%, is coming from high-quality recurring subscription revenue. And that slice of the pie is growing. It's up a really impressive 18% from last year. This isn't just a small change, it's a huge milestone.
And look, they're not just talking a good game. They're actually making some serious moves to back it up. They're cleaning house, selling off parts of the business that don't fit the new vision. They locked in a massive multi-year deal with the Defense Health Agency. That's a huge cornerstone client. And maybe most importantly, they put a date on the calendar. They're telling investors, we will be cash flow positive by the end of 2026. That's a line in the sand.
All right, so that's the story management wants you to hear. But now we have to flip the coin and look at the other side. Because despite that really compelling vision, the market isn't buying it. And there's a good reason why. Investors are looking at a completely different and frankly a much more worrying set of numbers.
And this chart right here, it just lays it all out in black and white. You've got this stark contrast. On one hand, yes, the new subscription business is growing nicely. But on the other hand, their old-school visit-based business is, well, it's falling off a cliff. Visits are down a staggering 21% from last year. That's not a slow leak, that's a gusher. And it's dragging the whole company's growth down with it. And this is the number that really matters to investors right now. Cash burn. The company torched through $18 million in cash this quarter alone. When you're burning cash that fast, that 2026 profitability promise starts to look a little shaky. People start asking, how much money do they have left? How long can they keep this up? This, right here, is what's really spooking the market.
And let's be clear, this isn't just a one-day blip. This isn't just a bad reaction to one report. This has been a long-term problem. I mean, look at this comparison. Over the last year, the whole healthcare sector is up a respectable 7%. Amwell? It's down more than 50%. That's not just underperformance, that's a massive disconnect. It tells you there is some deep, deep skepticism from investors that's been building for a while. So, what does this all add up to? It's pretty simple, actually. Wall Street has slapped a big, fat show me label on this stock. The time for telling a good story, for selling the vision, that's over. Now it's all about proof. The market is saying, don't tell us, show us. The only thing that's going to move this stock now is cold, hard results, period. Okay, so let's pull all these threads together. We've heard management's vision, we've seen the market's brutal reality check. So what's our final verdict here at Talk Tickers? How do we balance this thing out?
You know, our thesis is basically this. It's a giant tug-of-war. In one corner, you have management pulling on this rope of a long-term, really compelling AI vision. But in the other corner, you have the market pulling back with the brutal reality of a shrinking legacy business and that big cash burn. And right now, reality's winning that fight. The big risk here is all about execution. Can they pull it off? But man, the reward if they do, you could see a massive re-rating of this stock.
So, looking ahead to the next earnings call, here's what you need to be watching for. We've got a 4-point checklist. Number 1, can that subscription growth finally start to overpower the decline in visits? Number 2, do they announce any more asset sales to bring in some cash? 3, we need more details on that big Defense Health Agency contract. And 4, the big one, we have got to see that quarterly cash burn come down a lot.
And really, All 4 of those points boil down to this single crucial question for the next quarter. Is this the quarter they finally do it? Is this when they hit that magic inflection point where the new, shiny subscription business grows fast enough to make the whole company's revenue positive again? The next earnings report, it's going to be a huge, huge test for this turnaround story.
So, with all that said, here's our official call. We are initiating coverage on Amwell with a market perform rating. Look, the upside here is real. That AI platform idea is legitimately exciting. But for now, that potential is completely balanced out by the very real risks in the here and now. The execution risk, the cash burn, it's just too much to ignore.
And of course, just as a reminder, this is not financial advice.